Is there strength in utilities today? Has there been an inflection in the macroeconomic data? And a look at what investors can learn from investing legend Jim Simons. This in our chart of the week on Investment Insights from Opal Capital. Thanks for tuning in today. My name is Jay Coulter. Joining me, as always, on Investment Insights, Austin Graff and Adam Mueller. Let's start off with our recap for the three things you need to know from last week. The S&P 500 notched its third straight week of gains, which is the longest winning streak since February. The chatter around stagflation, an insight from our last show, has begun to show as first quarter GDP numbers came in lighter than expected and inflation expectations remain higher than the Fed's 2% target. If this persists, this will be the opposite of the Goldilocks scenario for the markets and the central banks. There's signs of weakness with the lower income consumer today. They're becoming more visible as McDonald's announced a new $5 meal in hopes to continue to drive the penny pinch consumers back into their stores. And the Starbucks CEO mentioned that they're seeing weakness in demand in their stores. Austin, what's your take on last week's data?
We continue to see this push-pull between valuations and underlying growth. You know, when we've seen companies that are missing on either earnings or revenue estimates, or they're reducing guidance going forward, they've been punished to an abnormally large extent relative to kind of past quarterly announcements. It's kind of unclear to us at this point whether that has to do with slowing growth or whether it has to do with higher interest rates for longer. It does seem, though, that it should be some combination of the two, depending on kind of which companies you're looking at. Some of those have been consumer companies, some referenced in the opening, whether it be McDonald's or Starbucks.
Adam, what are your thoughts?
Look, I can't help but think that over the last, let's say, 6 to 12 months, the market has been helped by this excitement around technology and AI. And to some extent, that I think has masked a growing weakness amongst the consumers, particularly lower income consumers. And now that maybe some of the shine is coming off of the rose of the AI revolution, just given valuations and how far those companies have run, we're starting that consumer weakness is starting to rise to the surface, and we're starting to see it. And that could certainly have an impact on where the S&P 500 goes from here through the rest of the year and past that.
Yeah, my take on that is the continued theme around inflation. Inflation is destroying the financial position of those who can least afford it. And it's creeping into the middle class and now the upper middle class. And at some point, this is going to impact market prices and portfolios. And it's important to think broadly about your diversified portfolio and the general implications of long-term prolonged inflation. Our first insight for this week is from Austin. It's around what he's seeing as it relates to utilities and strength in the sector. Austin, what's your take?
So utilities have been the strongest performing sector over the last week and actually the last month. We see a lot of talking heads go on TV and reference how I think some have said this is going to end in tears. We think that these talking heads have done a relatively lazy analysis just looking at historical trends with utilities, saying that they're near 52-week highs and they can't rise any further than here because they are essentially bond proxies. This is a backwards looking approach, and we think it's a false approach, or we think it's the wrong approach. We think investors need to start looking forward. And as Adam just referenced, we have this AI trend that's driving a ton of demand in the energy space. We also have the green energy revolution, which is causing a significant amount of energy to come from the petroleum side of the equation and move into the more traditional electric side, which is driving increased demand for many of these utilities. We think the formula has changed from utilities, from being a GDP-like grower to being a multiple GDP grower in the future. And we think at current valuations, this is an attractive opportunity for investors to get market-like returns without paying the high valuations that are ever present in many companies in the market today.
Adam, any thoughts on utilities?
No, I agree with everything Austin said. Excuse me. And it's utilities is an interesting space. I guess the only thing I'd add is sometimes when the thesis around why you might own a sector starts to change, that's when you can't get anchored in past valuation metrics, because the way that the market looks at that space may change completely. And for an example, would be a software company moving into the cloud. The valuations just change, and I think that kind of dynamic could be happening selectively within utilities.
Yeah. My biggest takeaway from Austin's insights is the dynamic change of not looking at utilities as a bond proxy, which frankly, it has been for most of my career, and not looking at it today as a net grower inside of a diversified portfolio. Adam, you have some thoughts around macroeconomic data.
Yeah, 2 data points caught my eye last week, and one of the things that's notable is normally these are data points that I wouldn't really pay a lot of attention to. But the first data point is that the University of Michigan Consumer Sentiment Index ticked down rather significantly, and that's a volatile index, but it's interesting to see that index reflect a less optimistic view amongst consumers. And initial jobless claims ticked up significantly from around 200,000 to about 230,000. Again, both of those I don't really pay a lot of attention to, but you see them both last week and look at the commentary around them. And what it made me realize is that the market is now looking for a reason why the Fed might cut. And those data points just on their own, that's not enough data to indicate that the market, or the economy rather, has turned. But you start combining those macro data points with what we've already talked about with respect to McDonald's and Starbucks seeing weakness in lower income consumers. And you do start to wonder if a few months from now, we might look back at this time period as the inflection point where the economy started to break, which is what has to happen for the Fed to lower rates, and creates a really interesting dynamic, particularly in an election year.
Austin, any thoughts on the data you're seeing from a macroeconomic perspective?
I think Adam's done a great job of summarizing the data. One thing I would just point to is the fact that the market seems to get overly excited about the idea of rate cuts, but then tends to sell off when rates actually cut, because that's an indication that the economy is getting worse. And so I think what the market's kind of saying right now is that they're hoping that the Fed cuts while the economy doesn't get that bad. But in all actuality, it usually means that the economy is worse than many expected. So things tend to sell off. It gets us back to this push-pull between growth and valuation. Current valuations assume that interest rates go down, but growth remains. That seems like a low probability outcome for us. So it seems if you want to really manage risk in your portfolio, you should be focused on quality and valuation right now.
My insights for this week come from the passing of the legendary investor Jim Simons. If you were not familiar with Jim Simons' work, he was a mathematician who founded the most successful quantitative hedge fund of all time. He left behind a track record at Renaissance Technologies that rival the best investors that have ever lived. His flagship Medallion Fund returned 66% between 1988 and 2018, generating more than $100 billion in trading profits. The quant guru founded that company in 1978 at the age of 40, which is a great reminder that it's never too late to start a business. One of my 5 rules of investing is to make sure you avoid gurus. There are managers out there who can consistently beat the markets, but you don't have access to them. The Medallion Fund was closed to new money all the way back in 1993, and Simons only allowed his employees to invest in it starting in 2005. The key takeaway: avoiding the idea that some market guru on CNBC can help you beat the markets will increase your chances of not making big mistakes in your portfolio and increase the chances of reaching your financial goals. Gentlemen, any thoughts on the passing of the late legend?
You referenced the $100 billion in client profits. I'd love to hear how much the banks or investment banks generated in trading commissions, as these guys' holding period tended to be measured in seconds and minutes rather than years as many active managers.
Yep. Adam, any thoughts?
Yeah, I'd reiterate what you said, Jay, that you got to be very careful listening to any specific investor. People in the investing world can get very famous and very rich for making a few very bold, aggressive calls. It doesn't necessarily mean that their next call will be right. So you have to take everything with a grain of salt and do your own analysis, make your own decisions. It doesn't mean you can't learn from what these folks have done because a lot of them have accomplished great things. It just isn't always transferable. And always remember, when you hear something, whether it's CNBC or some other news source, by the time an investing guru's telling you, it's too late.
That's right.
You've missed it.
That's right. Let's close with our chart of the week. This week's chart is from Bank of America Global Research. You can see from this chart that it shows 100-year lows in the relative value of real assets to financial assets. For those new to those terms, let me describe them to you. Real assets are simply real physical assets that have an intrinsic value to society, like real estate investment trusts, commodities, art, and others. Financial assets are what we've been talking about on this show. Stocks, bonds. They are a contractual asset that drive value from their ownership claims. In looking at this chart, it's important to acknowledge what we know as recency bias. Recency bias is the tendency to overemphasize the importance of recent experiences or the latest information in estimating future events. Since the great financial crisis, real assets have hurt your portfolio. But looking back over time, looking at LBJ's war on poverty until the very peak of inflation from the mid-60s to the early 80s, real assets in a portfolio provided real diversification. So here's the question for investors today. If you are concerned about inflation, do you have enough real assets in your portfolio? Austin, would love your thoughts on how investors should look at that.
I think there's a lot of ways to get, returns that the whole point here is to protect yourself from inflation. And so real assets are a great protection against inflation. Another great protection against inflation is high quality companies with strong balance sheets that can raise prices to offset the impacts of inflation. I think in the environment that we're currently going into as we look ahead with debt to GDP reaching all-time historic levels, and we're not even in a crisis, we're actually in a relatively solid or productive economic environment, it does seem that some type of inflation is going to be here with us. I think investors should be looking to real assets and also high quality equities as they look to protect their purchasing power over time for that point in time when they want to start harvesting the returns from their portfolios, and they want that cash flow. They want to make sure that they can afford the things that they intend to afford after inflation.
Adam, what are your thoughts on this chart?
Well, maybe I'm deviating a little bit from the chart, but what it made me think of is if you had $1 million to invest and you only had two options, you could either buy $1 million of sustainable farmland or $1 million of Bitcoin. What's going to do better over the next 5 or 10 years? What's going to be more volatile? Which one allows you to sleep better at night? And I don't know. I can't speak for everyone. There's some people that like to roll the dice, but I think I'd rather invest in the farmland.
Excellent. Gentlemen, thanks for another episode of Investment Insights. Viewers, to learn more about Opal Capital, please visit opalinvest.com.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.